All right, guys, today is day 2 of the 30 Days to Master Part-Time Swing Trading Challenge. If you haven't seen day 1 yet, go back and read that, specifically the links at the end, which are posts I've previously done that go over part-time swing trading, and it'll give you a good foundation for what we're going to be doing. Now, the focus on this 30 days is not just passively reading about part-time swing trading, but actually doing it and learning and mastering it. So with each of these, I go over a concept that I think is really important to becoming a successful swing trader, especially if you're part-time trading. Although this works for anybody, whether you're a full-time, part-time swing trader, you need to know these concepts. So we're gonna have 30 days, different exercises for you to actually put into practice. There's a lesson, a video lesson where you can go through and see exactly what I'm doing and then put it into practice. And by doing this, after the 30 days, you should be a pro at swing trading and part-time swing trading. So today what I want to do is go over analyzing the market. I'm going to share my screen here. We've talked about it a little bit already. I use a top-down approach to swing trading. Basically, I start off with looking at the market. I don't even think about stocks. So you can see a bunch of stocks here on the side. You can see some industry indexes. We're going to talk about that later, how I analyze the industries and sectors before even getting to the stocks. These are all stocks I've picked after doing an industry analysis and after doing a market analysis. And that kind of guides my stock picking. But before we even get to stock picking, to setups, we need to know what's going on in the market. And that's what we're going to do right now. So we can see here, the first thing I've talked about, and we've talked about answering these 5 different questions. And the first thing you're going to do is analyze the long-term trend. And what you can do is go to the weekly here and go out a little farther. Now, what happened in 2010 is really not going to guide us today, but it's good to know what the prevailing trend is. And if we go to the long-term trend is basically to the upside. So that's good to know. That helps us know that while we've been trading generally over the last, however many years this is, 7 or 8 years, probably 60 to 70% of our trades should be to the long side if we're trend trading. And most swing trading is more related to trends. There's different strategies you can use where you can be shorting as well, and we do a lot of shorting. But overall, I would say 60 to 80% of the trades during this period should be long trades. Now, let's dig in a little closer. Now we're going to go to the daily, and we're going to pull it out maybe about a year and a half. And we can see, again, the prevailing trend is to the long side. And this doesn't have to get too complicated. Just draw a line, and you can look at the moving averages as well. And we can see the 200-day, which correlates more to longer term, the 50-day, they're all pointed upwards. So again, the intermediate trend has been to the upside. But again, that's not really the time frame we're trading. If we're doing holds that are 3 days to 2 months, we need to look a little closer. So now we're going to dig in to say 6 to 8 months and what's happening right now. And if we do that, the trend changes a little bit. So basically we know the uptrend kind of ended here around January 2018. So January of 18, it's been a little bit of a tough year to trade. And as we can see here, the trend has been choppy now. Actually, we don't even have a trend. So the way I would identify that now is to say we are no longer in a short-term uptrend. We are in a range-bound market. We're not in a downtrend. Looked like we might get one in here. It didn't happen. We're basically trading within this range at this point, 255 to 286, and more near-term, really 280. So we know short-term now we are in a range-bound market. Now, how does that guide us? What that tells me is the trend trades, the longer-term holds, the holds I was doing, 2-month holds, 3-month holds, 4-month holds, they're not going to work right now. And setups related to that are not going to work. Trend type setups are not going to work right now. And the market analysis is telling me that. So that's what's guiding my trading. So now knowing we're in a range-bound market, I'm picking setups, I'm picking time frames that are more related to range-bound markets. So my holds are going to be much shorter through this period. and I'm not going to be trend trading quite as much. I'm going to be doing quick breakouts. I'm going to get out at top of ranges when I'm trading a stock. So this market analysis helps you guide that. So we see here, we're kind of in the middle of the range right now. Now, the other question we're going to ask ourselves is, how are the indexes relating to each other? Now, the indexes we use are SPY, the Qs, and IWM. Now, in a really strong market, I want to see the Qs doing well. That's big tech. We always want tech doing good. And we can see that tech is much stronger than SPY right now. SPY is down here in the middle of the range, while the Qs are at the top of the range. That is fantastic for the market. That helps guide me in two ways. One, I know I want to be trading tech stocks more. And two, it helps me understand that the market is actually underlying strong. And then IWM, same thing. IWM is a broader based index than SPY is. So if I see that IWM is leading, that is a good sign for the market, and we are now seeing that. So my market analysis is telling me, even though we're in a range-bound market, the market is strengthening. So maybe now I can think about adding more stocks, trading more stocks, which I've been doing lately compared to this period where I was rarely ever taking 1 or 2 positions. Now I'm taking anywhere from 4 to 7 positions. So this is all guiding me, that my market analysis. Before I even get to the stocks, I just know I can start trading a little more aggressively now. I can start going for maybe a little bigger win than I was during this range bound period here. So you can see how the market analysis is so important. Before I even get to the stocks, if I didn't do this, I would just be trading these stocks, not knowing which setups are really working in this market, kind of only doing half the analysis. And then you wonder, why are these setups not working? They're supposed to be good setups. And the problem is those setups aren't aligned with the market. So remember that. Start with your market analysis, and it'll really impact your trading. So we're going to have an exercise now, and what I'm going to ask you to do is take SPY and go back over the last 2 or 3 years. I just did the market analysis near term. Now, what I want you to do is go back to different points here and pretend you're in July or August of 2017. Pretend you're in right around election time, 2016. Pretend you're at early 2016. And do a full market analysis of that period and figure out how you should have been trading during that period. And then I want you to look at the stocks that did well during that period and see if they aligned with what the market was doing. And I guarantee once you do that, you're going to go back and look at some of the trades you took back then and say to yourself, you know what, now I've done the market analysis, I see that I probably shouldn't have taken those trades, or maybe I should have taken these other trades or traded in a different style. So that is going to be the exercise for day 2. Go back historically. You know, I've told you to do the last 2 years, but you can go back as far as you want in different markets and just do a quick market analysis.